Welcome to the daily update, where I'll go over the action in the market for Thursday, August 29th, and then we'll see how things look for Friday, August 30th. It started off positive. Well, we have to go back to Wednesday's session. After Wednesday, NVIDIA reported their earnings, blew everybody out of the water, but some folks had these ultra high expectations, and so that sent NVIDIA lower. It also took the futures lower with it. Then, as we went through the Asian part of the session and then into Europe, things were shifting back and looking more positive. And we actually went from being negative to positive with the futures. We had a higher open, looked like, okay, we're just going to build off of this and keep going. Then we hit a top, which is kind of at the high range of the sideways range that we've been in for the last number of days. And we reversed. And we ended up being unchanged for the S&P, but well down from the higher levels that we saw earlier in the session. It hasn't really changed the climate all that much. We're still positive in the short, intermediate, and long term, but we have to ask this question. Is weakness starting to develop? Are we going into a non-trending environment? This is the last trading day of the week before a 3-day weekend. Then after Labor Day is when folks start coming back. We should being the operative word, see volume start to pick back up, see a little bit more conviction. And we don't know if that's going to be to the upside or the downside. The market is still looking vulnerable right now, but it's still positive at the same time. The broader areas of the market are actually looking more solid. The mega caps and especially NVIDIA, it dragged things down in Thursday's session, but we'll see if some support level can be found at some point and then we can bounce up from that. Or are we going to shift more into a negative environment? We're kind of in between right now, but for the time being, we are still positive. Okay, I do have the SPXInvesting Program. It's available. There's a link to take you to the website. Feel free to check that out. There are additional videos and posts that I make there that I don't do on YouTube or Rumble. And the daily video is the real foundation of all the analysis that I do. I know my videos are longer. I know I go through a lot of extra information. That's all by design. That's also made the approach that I use very accurate over the last decades of actually doing things this way. But I know people want fast answers. They want to be told what to do. In fact, I'm going to address that here in just a moment with some interesting posts that I found on Twitter or X. But if you want to know things on a day in and day out basis, and you've had the time to do that, please go through and look at the daily video. And then all of the other videos supplement the daily video. Okay, let's go back and talk about what happened and then look at some charts. We did have a higher open. And it looked like, okay, maybe we're off to the races today. We climbed above R1 at 56.26, and then we stalled without breaking above the recent range. And I actually made a post about that. We were just at the high range, and I'll show you when we go into the charts. Then we reversed, and we declined below R1. We did find support at the daily pivot at 55.93, and just a little bit below that was the unchanged level. We tried to rebound a little bit near the latter part of the day, but that just didn't really take, and we ended up closing unchanged. Kind of a rare event for the S&P. So we were unchanged from that aspect. We came up with volume, but we're still below average overall. And we're still positive in the short, intermediate, and long term. There are some overbought conditions. There's also a concern that we're going to go sideways, at least for a little while longer. We don't know when we're going to be able to break out of that. And in Friday's session, we're going to get a key inflation point of data with the core PCE coming out, and the market will undoubtedly react to that. And then all the different geopolitical things going on. Just want to be aware of those things in case they impact the market. So mega caps in NVIDIA did underperform. I think NVIDIA was down over 6%. We'll look at the chart later, but we're not seeing any real follow through strength with the mega caps. They have a good day, then they have a bad day or two, and then they have a good day. And that's a real indecisive market right now on below average volume. And we're still working off of this mass index. It's an indicator that was going up while the S&P was going up. It triggered while the S&P was getting near this range that we've been in now for a while. Is that signaling some kind of a reversal? We don't want to look at that chart by itself. We want to use it in context with other charts. Here's our short-term list with the 20-period exponential moving average, the slope oscillator, the Williams percent R and stochastics, and that 20-period moving average study. I've been kind of focused on that one lately. Intermediate term, we still have the TTM squeeze. It continues to go up. There's one area of the PMO studies, and then the 10-day moving average of the S&P 500 highs minus the lows. And we're still looking kind of extreme with the 200 and 150 simple moving averages. Now, as I always say, you can show that as a source of good momentum, but at the same time, it can also point to exhaustion. And as we continue to chop sideways, eventually the market's going to break to one side or the other. And then no real change here with the scenario. The economic concerns that seem to be really freaking the market out at the beginning of August, those seem to have pretty much gone away, but they can come back at any time. And the Fed is pretty much said they're going to cut rates in September. We just don't know how much that's going to be. The dollar was up and interest rates were up. This also pressured stocks. We closed at 3.87% with the 10-year yield, where we had been at 3.84%. We're still inverted with the yield curves. Sentiment actually ticked up because the broader market was actually positive in Thursday's session. It was the mega caps and Nvidia that dragged everything down. We're at 58, so now we're in that positive area. Now, according to CNN, this is the greed area. I switched the word around because I think that's more positive. So we can tend to go with that, where we had been neutral at 52. Our trend is still positive. The green line's coming up a little bit, and I made a post about this on the website as well while the market was open. But the ADX is still weakening. We're coming down. We're below the moving average. We're in danger of dropping below 20 with the intermediate term chart. We've already dropped below 20 with the short term chart. That means we're going from a trending environment to a non-trending environment. And I still kept the bias at negative, even though it was an unchanged day. That's because Wednesday was negative. And now I've switched our momentum over to mixed. Now, what I try to do in these videos, and it's my approach to education and how I teach, is I don't try to tell you what to think or what to believe or what's right or what's wrong. I just try to amass as much information as I can together and then say, okay, this is clearly positive. This is clearly negative. And then we do some interpretation along the way, but you may come to a different conclusion. The bias, that's usually pretty objective, because if we have an up day, the bias is positive. A down day, the bias is negative. The momentum is like the last number of days taken together. And these two areas are kind of the only subjective areas in the video that I do. I try to let the data speak for itself. But this is an area where, okay, I actually kind of interpret things in my own way. All right. We did get a whole list of economic reports. I have some charts to show you, but not for everything that's listed here. We had the advanced international trade in goods. It was down 102.7 billion, down more than the 96.6 billion from last time. Retail inventories were up 0.8%. Last time they were up 0.9%. Wholesale inventories up 0.3%. Last time up 0.1%. This is a chart that I will show you. And the weekly jobless claims came in at 231,000. Last week, they were at 233,000. Continuing claims, 1.868 million, up from the 1.855 million that we saw last time. The second quarter GDP, not a real big influence, but it did come in stronger than the 2.8 we saw the first time. Now we're coming in at 3.0. That's actually more beneficial for the economy. It shows that we're growing a little bit more. But there's a little bit of a concern here where the second estimate of the GDP deflator, this is the inflation component, it came in up where the first time it was at 2.3, it came in at 2.5. But this isn't the main inflation gauge that the market follows, but it still follows it nonetheless. Pending home sales were down 5.5%. They expected them to be up 1.2%. Last time they were up 4.8%. Okay, here are the weekly jobless claims. We follow the raw number itself, which they are declining, but we also follow the 4-week simple moving average. That's the blue line, and that is coming down. That means that the employment situation based on this is still hanging in there. We're not seeing jobless claims really shooting up. It's not really suggesting there's real weakness in the employment area for right now. But we are seeing a bit of a tick up and the moving average slightly going up when we look at continuing claims. These go beyond the first week and just measure, okay, who are folks that are still unemployed. This is a little bit of a concern, but it didn't see as much change to the downside. Well, actually, this went up a little bit, but where the weekly claims actually came down. So just to kind of give it a little bit of perspective, we at the beginning of August, we had the latest reading on unemployment. We're going to get that coming up next week too with the employment situation report. We see a little bit of a tick up here with continuing claims, but a decline in the initial claims. Here's the real GDP. This takes inflation into account and the deflator on a quarter over quarter basis. The GDP is in blue, and that's actually bumping up a little bit. That's showing growth in the economy, where the deflator, even though it came in a little stronger than expected on a quarter over quarter basis, it's still declining slightly. And personal consumption on a year over year basis, well, it's the summer months, you know, you got to drink that Coke, drink that beer, eat that hamburger. It's going up a little bit more here. And the net exports, this is always negative because we import more than we export. So it's actually showing a bit of a decrease. You have to flip this around to a less negative number. And then real GDP on a year-over-year basis, this is looking pretty solid when you take inflation into account. We're not seeing anything negative, at least to this point. And that's one of the parts of a recession is that we have negative GDP for 2 consecutive quarters. All right, here's something that's kind of interesting. And for some reason, Isabel Net focused on stock ownership and households and things like that. This is real household net worth. That's taking inflation into account. And that's the real GDP down here is in blue. And then we have this black area. This is households and nonprofit organizations' net worth and their level. Just giving you an idea of where we're at with things right now. And then households are heavily allocated to stocks. Not a real surprise there. Over the 100+ years, actually it's been a few hundred years, but since the US stock market has become very well established and more of a fair place for people to invest, most people see the value of owning stocks, whether they own them outright and have their own portfolio. Maybe they do some short, intermediate, long-term positioning type things, or it could be your retirement, your 401k, your Roth IRA, or some kind of a pension plan that you're involved in. But it's about the highest that it's been at about 40%. And this is ownership breakdown of the equity market. This just takes in the different areas. And households are right around the 39%, according to this. And there's different numbers depending on what data you use, but it's coming into the value at being 78 trillion right now. And gold, just want to keep an eye on that. The gold bugs who've just been touting this for decades, they're finally, this is a good summer for them because they're going up. And they've been saying, you know, especially the Elliott Wave folks, they always have a down arrow for stocks and an up arrow for gold. Well, it's finally starting to happen now. And so, and we're seeing central banks really purchasing gold, not necessarily paper gold, but the actual physical gold. And it's pushing the price higher. This is seen as a hedge against inflation. Also, when things kind of start to go crazy, we see gold going up. Because gold is always worth something. It was worth something thousands of years ago. It's worth something now. It's a precious metal. And so if you physically have some gold, you have some, you know, it's kind of hard to change a gold bar and, you know, give me 14 silver bars and change or whatever. But just having the physical asset itself can really be some benefit. Okay. And then this is Bank of America, and the dollar's been under pressure lately. Now, as soon as they come out with this chart, the last couple of days, the dollar's been up. But these folks that tend to go with what's already happening as well, even though they're professionals, they're seeing where the dollar will decline. And that could be very true. We're still above this 100 level for the time being. We dropped down below 100. Now, this could actually benefit stocks because they like a weaker dollar. But it's also decreasing the value of the dollars, and that's kind of a form of inflation if the dollar does decrease. And it's not that the dollar is all that magical and wonderful. It's just when you compare it to the euro and the Japanese yen and all the other world currencies that aren't backed by anything like gold, like we used to be, this is like the least crappy of all the crappy, okay? Or the least bad smelling pile of manure compared to all the manure out there. So it's not like any of the currencies are standing on real solid ground right now. So anyway, and then 34% of large cap mutual funds are outperforming their benchmark. Okay, now that might be all fine and dandy, but what about the other, what is that, 66%? That means they're underperforming. These are the high flying managers who are supposed to know what they're doing, and they're underperforming the market. You'd be better off getting into an S&P 500 index fund. And that's why the SPY or S&P 500 index fund is typically in an environment like this where we're in an uptrend, they do better than these mutual funds or even ETFs that are actively managed, where the folks try to get in and get out and time the market and do all that other stuff. So yeah, they're still underperforming overall. That's why we're seeing a real shift over into what they call passive funds, because you don't really do anything. You're just getting into an S&P fund or a NASDAQ 100 fund or a Dow fund and just riding that index up or down. It's when we really start to decline with the indexes. That's when the more managed type of mutual funds and ETFs actually do better, because they do have more strategies that they can implement. They can maneuver things around. All right, and then equity allocation at 62%, not as high as it was back in earlier times here, but it is going up. Most money is actually going in to the stock market now. And the public debt to GDP ratio, and then this is a forecast, and they just have it going up. And you just wonder, how sustainable is this? But then I showed a chart in yesterday's video that shows that there's other countries that are even in worse shape than the US as far as a debt to GDP ratio. And then this is just some kind of a way that folks are predicting. This is the corporate tax proposals based on, we really don't know what Harris's proposal is, because nothing's really been stated there. It's just through some of the staff and so forth that have said, that have changed their mind about things. And then the status quo, this is what the stock market would actually like here. And they see corporate rates at about 21%, where I guess the Harris proposal is at 28%, where Trump is realistic would be at 20%. And what he'd like to do is get things down to 15%. And so, but this is going to change. This is all hypothetical at this point, but I thought this was an interesting chart. Now, this is some area that, and I constantly rag on these guys all the time. Some of these folks, I'd never heard their name, but other folks I watch from time to time. I have to be kind of in the right mood. But this is Seth Golden on Twitter, and I don't follow him. It just kind of came up in my feed. It said the top 10 who have lost investors more money over time. Now, a lot of people were saying, where's Kathy Wood? Where's Kathy Wood? She manages ARK, the big ETF that was all the rage a few years ago, that's really been struggling. I don't know if they're actually picking out money managers per se. I think it's folks like me that do videos this way. Instead of trying to do it in a more objective way like I do, they come out and say, this is going to happen, that's going to happen. And they end up being wrong, especially when you're a perma bear. And I always say, I'm not a perma bull, I'm not a perma bear, I'm a perma realist. There are times when we expect the market to go up and we see things as positive. There are times when we think the market's, or it looks like the market's going to go down, and we adjust things according to that. And we have strategies in place so that when things go against us, we're hedged. And when things go in the direction that we think it's going to go, we can profit really nicely across multiple time frames, and even using different strategies in different environments. But some of these, I don't pay attention to these guys all that much. I used to kind of follow along with some, and this should actually be Game of Trades, not Game of Thrones. I've even said that in a video in the past. I never even watched the show Game of Thrones. I know, shoot me, but that's just not my kind of thing. Lord of the Rings and The Hobbit, that's about as far as I get into those areas. But like Zero Hedge, I get their emails every day, but I don't read them. And some of these you might have heard. I've heard of Eric Cantor, Liz Ann Saunders. I've heard of those. And then somebody said those who sold Apple since the headlines broke concerning Warren Buffett sales. It's been up 10%, at least when this post was made. So, that's why I don't have a big channel. That's why I don't get as many views. I'm not trying to start a religion with what I do. I'm trying to promote critical thinking where I give you the information. I tell you, okay, this is how I am interpreting that. Now you interpret that a different way. But no, these other YouTube channels and Twitter feeds, they have millions of followers or hundreds of thousands anyway. But these guys are, I just don't agree with it. In fact, I used to have Game of Trades as one of my favorite or recommended channels, but I took that off because I just felt, okay, I'm not really being told anything useful. And that's where I come out here. And then there's some other folks, I haven't heard of most of these people. There was a period of time a few years ago, there was like a special, a fire sale on Harry Dent books. So I picked up a number of them and I read through them and I'm like, man, this guy's a real doom and gloomer. I mean, you can see the kind of logic that he's coming up with. But I've seen some interviews with him and it's always end of the world, just around the corner. But yet he's been touting that all along. And look at how we've been going up. I have heard of Robert Kiyosaki. I did follow Jim. I've read a few Jim Rogers books over the years, but I don't really follow him. He used to be a guest on CNBC back when I would watch it, but I never have listened to any of these folks. And you may know some of these people. You may actually watch some of these people and listen to them. You may even have this to add to this. And if you want to add to it, feel free to leave a comment. And somebody else. I'm not trying to start any kind of a problem here. I'm just trying to differentiate between my approach, which is, okay, you got to develop a skill. It's going to take some time. You got to do thinking on your own, and you have to reach your own conclusions and your own decisions versus, oh, this guy told me what to do and I followed him. And, Jim Cramer's not on here either. I think the guy's a rodeo clown and should be just treated as entertainment. All right. Now, this is also put out. I don't know who put this out, but are we hitting some kind of a double top? I put the text on here, but yeah, I mean, you can make a case for that right now. That's why I put a question mark, because we don't know. We might be able to break out to the upside, or this might end up being a double top, which is part of a technical analysis formation or pattern that we just want to keep an eye on here. And then this is what we call the 4 comma club. These are all the companies that are now worth over $1 trillion. And the latest entry was Berkshire Hathaway. But this just gives you a list and all of the different valuations. Of course, this changes all the time. But yeah, I still remember, how was it, 10 years ago, maybe, when Apple, they closed at a valuation of 666 billion. And everyone, that's the mark of the beast. The Apple is the Antichrist, and we're coming to all this. People just go nuts over this stuff. But since then, they've gone beyond that. And I just thought this was an interesting list to look at. This is put out by sentimenttrader.com. And we've been keeping an eye on the financial sector, and it's looking good. In fact, maybe a little too good, because according to Sentiment Trader, most financial sector stocks are overbought right now. It's a very high reading. If we see a bit of a pullback in that area, we'll be watching it, because that's an area that really crumbled during the great financial crisis. If it just pulls back because there's profit taking, that's one thing. But if we start to see it roll over and actually turn into something else, then we'll be keeping an eye on that. And then history of Fed cuts. I'm not going to go through all this, but the thing that I would say with this chart is, and I constantly harp on this, what's the context? When the Fed comes in and cuts rates, why are they cutting them? Is it because the economy's doing good and inflation's under control and they want to help the economy grow a little bit more? That's positive. If they're cutting rates because of lockdowns, because of a financial crisis, because things are falling apart in the economy, well, no amount of rate cuts is going to help the stock market. It's going to go down too. So there are times when it's positive and negative. But just to make a blanket statement, when the Fed starts cutting rates, that means the market's going to crash. No, not necessarily. It could, but we have to know what is the economic context of what's going on at that time. All right, here's the chart, and look like, wow, maybe we're really going to get back to looking more positive. And for the first part of the day, we were. We did gap up higher. We got above R1, and then we stalled out just about at the high range that we've been hitting a number of times. There's really, that I could tell, no real significant overhead resistance. It may have come from a different index or something that we'll go through as we look at the charts. And then we topped out, slowed down. You can see we were going up on a decrease in volume here. And then we just reversed, and it looked like, okay, it's just pulling back, just pulling back. Oh my gosh, we're going fast here. We came all the way down to the daily pivot. We tried to break below that. Now this ended up providing really good support because we tried to break below it a couple of times. Actually, 1, 2, 3, 4, 5, 6 times. And then a bounce was tried to go back up. That really wasn't happening. And then we ended up pretty much changing, or we did end up being unchanged on the day, but we're below that 5,600 level. Here's the intraday chart, and we're up a little bit in the initial overnight session there. This is a concern that we've been watching, even though the red line and the blue line are down. The red line above the blue line means that value is outperforming growth, and that's more defensive on an intraday basis. Also, we've been coming back down here since about August 20th, 21st. We're seeing a gradual decline here with the growth to value ratio intraday with the S&P. And we were down with growth where value was up. That was more the positive area of the market, and that's what we're keeping an eye on. When value starts to outperform growth consistently, that could mean the market is getting more defensive. And growth was up for the mid caps, but up less, and it was up more for the small caps. So we saw kind of a mixed picture there. And just in case you're not used to seeing this middle area, I usually don't talk about it. This would be like SPY. This is MDY. This, I think it's IWM or SML. I'm not sure which. These are the actual ETFs for those particular areas of the market. I just focus on the value and growth side here. And see how we're breaking down here with the small cap growth to value. We're also breaking down with mid cap growth to value. We ticked up a little bit, and we're going down with S&P growth to value. This is not the sign of a really solid market. We want to see growth really outperforming value. We saw a bit of a tick up here with discretionary to staples, but again, we want to see more of this, not just a day or so of this ratio going up. We want to see more of a sustained upward move. And we're coming down a little even deeper into the rainbow here with the growth versus value ETF. Large cap growth, we're still above the 50-period moving average. So that's holding up for right now. Where with the NASDAQ and NASDAQ 100, we're under the 50-day moving average. And this is a concern, and I added this to the post that I made where we've been range bound over the last number of days here. And when we were at the highs, I was watching this, and we were not able to break out above this level. Then we started to go down. We closed pretty much at the low for the session, and we're seeing the ADX continuing to decline, and we're just about ready to drop below 20. That means a non-trending environment based on a static number where it's below the moving average. Now, the green line did tick up. It's hard to see, but we are still positive here, and the red line did decline. So we do default to the positive side, but we're concerned. We want to see the green line really going up, and we want to see the ADX turn back up and cross above its moving average. And it's just not doing that, where we are below 20 here in the short term. And so we're not trending that way, which is no surprise since we've been chopping sideways here. The green line was pretty much flat, but we did see the red line decline slightly. So we're still positive this way. And we ticked up a little bit with volume, but we're still well below average. And I didn't show this a week ago because it wasn't updated, but the Investors Intelligence came out with their latest survey coming in at 2.35, which is pretty much neutral. We're not extreme positive or negative. The Ulcer Index is dropping down below its moving average, and we did decline with the VIX, both on the line chart and the bar chart. And the VIX of the VIX also declined with the bar chart and line chart. We're still going down with the momentum of the VIX, but we've been chopping sideways as the S&P's been going sideways, and now the MACD is in danger of starting to turn back up. And we might see some seasonal upward movement with the VIX. That would mean stocks are going down, especially if we get into September. Now, we don't know, but September is typically quite negative for stocks. Is this time going to be different? It's not 100% down for September, but it's a high percentage of the time that we're down in September. We're still seeing a signal here with the skew index where we look at the VIX, that's at the money options. The skew looks at out of the money options. We came down a little bit, but the market is still expecting some kind of a big move. Is that going to happen on Friday with the core PCE? Is that going to be the catalyst? Or is it going to draw out over the weekend and the big move will come next week? We're just kind of waiting to watch that happen. We did get the latest reading from the American Association of Individual Investors. They're coming in at 24.2 here, a little bit more positive, but not necessarily an extreme reading. And we were up slightly with this fear gauge where we were down just a little bit with the other fear gauge. So a bit of a contradiction there. Not seeing any real strength from the risk on versus risk off ratio. That means that folks are getting into the high beta stocks like the NVIDIAs and the Googles and the Microsofts and the Apple and all of that. They're not really doing it right now based on this ratio. And we're not seeing any real strength here with the large caps versus the small caps. But the equity put call ratio on the daily chart did decline enough to send our 5-day going back down, but it's really hard to see, but our 10-day is still going up. So a little bit of contradiction there. Volatility risk premium still very low, but it is starting to climb. We're well below this band. This is also showing there's not a lot of fear right now. We're still looking pretty good here with the advanced decline line for the S&P. We're setting another high based on price. We're flat based on volume. That's a negative divergence for the time being, but this is still fairly positive. This is also fairly positive. We set some new highs, really not much of an expansion of new lows. Because we're coming down a little bit, that's causing our 5-day to roll over, but it hasn't crossed below the moving average yet. But our 10-day continues to go up, and this is another internal measure that's quite positive. And we're still positive with the advanced decline ratio. Here's another breakout of the advanced decline ratio, declining after being extreme based on price and volume's leading a little bit to the downside. We're breaking out with the cumulative advanced decline line for the S&P, where we're lagging behind and actually decline based on volume. That's a negative divergence that we're concerned about. But we look at the 10-day average of the highs and the lows for the S&P, still giving us a very, very high reading, and that's quite positive. We compare the S&P to the NYSE advanced decline line, where the advanced decline line went up as the S&P was unchanged. That just shows the broader market is holding up fairly well right now. Accumulation distribution coming down with the boom indicator after being extreme, but we're rolling over here. We're still above the moving average, but we are seeing some weakness in this smart money indicator. But the Chaikin money flow continues to go up. That's positive. But now we're still declining with the Chaikin oscillator. So even our smart money indicators are a little bit conflicted with each other. The vortex still has the green line on top, but it's declining. The red line, after being extreme, is going up. But this is still positive here. And then we look at the advanced decline line for the NYSE common stock based on price. It went up and actually went up, but not quite as much based on volume. And then the accumulative advanced decline line on the NYSE is going up, not beyond this previous high, but above the moving average. And we ticked up slightly here with our regular NYSE advanced decline line and this other NYSE advanced decline line. Positive here with the new highs minus the new lows. The daily score is still positive there. And we were up with the common stock for the advanced decline line. We were up a little bit with the S&P, mid caps, and small caps. So even though we were unchanged and the mega caps and NVIDIA and all that, they're not really helping the market to go higher, the rest of the market is still hanging in there. Short term, just chopping sideways right now. And even though we're below average with volume, it did pick up on Thursday. We're still extreme with the 20-period exponential moving average of the S&P. We're not extreme with the 50 or 200. Here's the condition of the 20-period moving average. We're coming back down into the lines now. If we break below that, that'll eventually turn the lines down. But we're still above the simple and exponential moving averages. That's positive. As we chop sideways, we're still above all of the plotted moving averages here. That's still positive on a trending basis. The Stochk RSI is not extreme. The Williams %R is declining, but is still extreme positive. The CCI 14 and the CCI 20 are not extreme positive. We're still extreme in the short-term stochastics, intermediate short-term, and we're rolling over in extreme positive in the long short-term. We're declining, but still positive with the force index. We're coming back down into the +1 channel with our standard deviations here. And this is what I've been focusing on. right now, 87.4. I don't know how you can get 0.4 of a stock, but this is the percent of stocks in the S&P that are above their 20-period moving averages, still getting a high reading. There's two ways to read this. That means there's good momentum on a short-term basis. This is also an extreme reading, which sometimes can point to exhaustion. And that's kind of what we've seen. As we've been getting really high readings, the S&P has been chopping more or less sideways. Here's our study. Still, you can take this as good, solid momentum, but also looking rather extreme. We went up with the 50-period study, up with the 100, and up with the 200. So even though we were unchanged with the S&P, the other stocks are holding up pretty well. Intermediate term, balance of power is declining, but still positive. Here's the condition of the 50-period moving average. We're still above both the blue line and the red line. We're above both the plotted moving averages here. And we're switching over and looking a little more neutral with the go, no-go system, but still positive with the lighter blue. And we're off of the highest high. That's the blue line here, but we're still above the midpoint. But the TTM squeeze just keeps going up here, and we're getting a really extreme reading, and you want to keep an eye on this. At some point when this tops out and starts to turn, now we didn't see much of a change here. We saw more sideways action, but we did see a reversal here back in 2022. We don't know how it's going to actually play out, but this is a concern to us because we're getting such an extreme reading. We're declining, but still positive with the ease of movement. We're flat with the Erin indicator, but still positive. We ticked up and we're positive with the S&P McClellan oscillator. We're going up based on price. We're declining based on volume. This is a concerning negative divergence to us. We're going up with the McClellan oscillator for the NYSE. So we're going up based on price and volume. So they're more confirming each other. And we're going up a little bit with the Swenlin trading oscillator, but we're going down with the Swenlin trading oscillator based on volume. This is also a concern. We're seeing volume weaker than price right now, but overall, both have been declining, even though they're both above zero. Momentum slowing down a little bit here, but we're still positive with the PMO, also rolling over a bit based on price and rolling over a bit more, but haven't crossed below the moving average based on volume. We're no longer extreme, but positive here with the PMOs that are rising. We're still extreme with the buy signals. We continue to go up with the PMOs above zero. The parabolic SAR still has the dots underneath, so that's positive. We're still neutral with the Elder's impulse system. The slope oscillator is still going up, showing short-term momentum is positive, but possibly a little too positive as it gets extreme. The MACD is starting to roll over a bit, but it's positive. So here's the slope oscillator getting to a really high reading. Rolling over a bit with the other short-term oscillator, the TSI, and we're starting to roll over with the MACD, just topping out possibly with the PMO, rolling over a bit with the PPO, but still going up with our longer-term oscillators, the TRIX and KST, rolling over, but still positive with the Copy Curve momentum oscillator, still looking positive with the Sean trend meter. This is encouraging too. The bullish percent index did go up, even though the S&P was unchanged. This is seeing a continuation of buy signals inside of the S&P 500, and that is quite positive. And we're also going up with the NYSE bullish percent index. We're going back up and not quite extreme here with the NASDAQ 100 bullish percent index. So this is showing good point and figure buy signals across the market. The money flow is flattening out after giving us an extreme positive reading, but it's still positive. The ultimate oscillator is declining, but still above the midpoint. And we decline, but we're still above the moving average with on-balance volume, declining with our RSIs, both with the 14 and the 9, but we're still above 50. This is the mass index, and we're wondering, okay, we haven't seen much of a reversal yet. We did get all the parts of this indicator signaling, and since we were going up to signal this indicator, that means it's anticipating a reversal, but we're not really seeing that yet. And the Pring bottom fisher, for some reason, thinks that we bottomed and is generating a buy signal. We're still looking good here with the weekly chart of the S&P. We're above this R2 level, and we're still below the 61.8 fib extension level. We were just not able to break out above that. If we do, that would probably generate a new all-time high. This is why some people are saying, oh, double top, double top. We don't really know that yet. And then our different charts, we're looking more negative here to actually indecisive with the Heiken Ashi, where we're looking more positive again with the Kegi chart, and we're positive with the Renko chart, we're positive with the three-line break chart. The trend is still hanging on to the positive side. It's just when we look a little bit deeper, that's when we're seeing some concerns. And here's the 150 and 200. It's still looking rather extreme there. And we're positive across the board with the Keller market model on all time frames. And we're switching back to positive with commodities in the short term, where they're still negative in the intermediate and long term, where the dollar is still under pressure, even though it's bounced up the last few days. And here we see energy was in the lead. Financials still looking pretty solid. Technology ended up being down the most, and staples actually fell back a little bit, as did real estate. A lot of positive things that happened not long after the open here with both the S&P and the NASDAQ. Not an awful lot negative as we were coming back down from here. The tech sector did have a BPI cross above 70. The Dow did set a new all-time high, at least on an intraday basis. I'm not sure if that's closing or not there. And the equal weight is going up where the S&P was unchanged. That just shows that the rest of the S&P is holding up here. And we were down a little bit, showing that the mega caps underperformed with this ratio. And here's the Dow, which is barely an all-time high. This is kind of a doji looking bar right here, even though it was up 0.59%. It had been up more than that. We're neutral here with the diamonds for the Elder's Impulse system, and we're still below the 50-day moving average with the NASDAQ and NASDAQ 100. We're now negative for the second day with the QQQs with the Elder's Impulse system. And we're still positive with the momentum of the NASDAQ 100, but the PPO is starting to roll over a bit, and that's a concern there. And we're below the 50-period moving average here with the Qs. And that we actually dropped below that after Wednesday. We're still below it after Thursday. And still dancing around this 23.6% fib extension level. Not really showing an awful lot of strength. Has a ways more to go to get back to its all-time high. Small caps were up almost 0.5%, but not really breaking out at this time. They continue to be neutral with the Elder's Impulse system for the small caps. We're above, when we look at the small cap, Russell 2000 small caps, we're above 50 with the RSI, the 50-period moving average, and the momentum is still positive there. We look at the small caps to tech ratio, that is going back up, meaning that the small caps had a better day than the tech sector did. Mid caps still above this pivot point, still above its 50-day moving average, but continue to be neutral with the Elder's Impulse system. The Wilshire closed well off of the highs and was virtually unchanged itself. This is another broad market measure, and we are up just barely here with the total U.S. stock ETF, but it's still looking positive nonetheless. The staples to tech ratio is starting to go back up as staples had a better day than tech. Financial sector up 0.89% and looking solid, and this bodes well for the U.S. economy. The FANG index is still under its 50-day moving average, and it was actually down slightly. It just could not get above its 50-day moving average again. And we're still below the shorter-term trend line, but we haven't come down to this longer-term trend line, at least yet. Apple was up 1.46%. We had Amazon up 0.75%. Microsoft up 0.61%. Meta was up 0.25%. And then Google was down 0.66. Is this the company of the beast here? But still above its 200-day moving average. Here's NVIDIA down 6.38% and dropping below its 50-day moving average. Tesla was up 0.25%, just barely above its 200-day moving average. Netflix was up 1.25%, not really breaking out, at least yet. Then we look at a broad market measure of the 5-period moving average of the highs minus the lows. We're looking positive here from a broad market perspective. We're actually showing a little bit of a decrease in the short-term relationship between U.S. and international stocks, and we're flattening out here with a longer-term correlation. Oil is in the mid-70s still, even though it was up. And the dollar, after being in a downtrend, has now started to bounce back up a bit. We were up with the 10-year yield. We were down with the 10-year based on price. And then we're not seeing any real strength here when we look at the growth to value ratios for the Qs to S&P, discretionary to S&P, large cap growth versus large cap value. So we're declining with the large caps, mid caps, and small caps. Not what you want to see in a really solid environment. The S&P to utilities ratio was down, but we've been just chopping around lately. Not a lot of conviction there. We're going back up with the staples to S&P ratio, which we want this to go down to be more positive for the S&P. So what's our outlook? Please be reminded that the markets will be closed on Monday for Labor Day. The technicals, we're still positive. We're still dealing with an overbought condition on below average volume. That 20 period moving average is still extreme. We have to ask, is weakness starting to come into the S&P? You can make a case for either side. We just want to be open to that for right now. It was a concern that we saw an intraday reversal. Strong open, a reverse, and gave up all those gains. We're going to get PCE and core PCE in Friday's session, personal income and spending, and consumer sentiment. We'll see how the market reacts to those. All the crazy stuff going on in the world, if it has an impact. And here is the finishing out of the economic calendar here. There's also another look at the economic calendar. We're neutral to negative with the Dow and NASDAQ, where we're neutral to positive with the S&P, but not really much of an edge either way. It's right around 50%. So you can flip a coin when you look at this seasonality chart here. Friday tends to be the second most positive day of the week based on what happened in 2023. And it's also the second most positive day based on what has been happening thus far in 2024. And we do see a little bit of negative seasonality going into the last trading day of the month, and a little bit of an uptick during an election year. So again, we're seeing some contradiction in these charts for the time being. And we're trying to figure out, is this all election years, which tends to be more positive, or when there's an open field election, which is kind of what's happening now? We do end up seeing some weakness as we go throughout the month of September and into October. And then September seasonally can be weak, where August has typically been strong. August is strong, September is weak according to this chart. You take August through October together, and we tend to see negative returns overall. Now, we're coming out of the end of August here. During an election year, that's when it tends to perform its best, but during any time in September, it tends to be negative, according to how it's measured here. And then we're just trying to match up, is 2024 acting like 2023 did? In some ways, yes, and in some ways, no. So the warning signs, we're still keeping an eye on these defensive sectors, specifically staples, utilities, and healthcare. We're keeping an eye on energy, and I'm mainly watching oil because of the geopolitical things going on. And the equity put call ratio based on 10 periods is still going up, where the 5-day has now switched to going down. We're just not seeing any help right now with the market. With growth to value, saw a little bit of a tick up, but we'll see if that can sustain when we look at discretionary to staples. We still have a pretty long list of positive things. Accumulation distribution coming down, but still positive. Chaikin money flow still looking positive there, but we're declining with the Chaikin oscillator. So a bit of discrepancy there. The advanced decline lines are doing quite well. And the S&P and NYC McClellan oscillators and summation indexes, when you look at them based on price, yeah, doing fine. But we're declining with the S&P based on volume. That's a negative divergence. And the Swenlin trading oscillator also diverging, going up with price, going down with volume, but both have been declining even though they're positive. The parabolic SAR, not only the daily chart, but the weekly chart are positive here. We're still positive, but showing a little bit of rolling over with our oscillators on the momentum side of things. The bullish percent indexes, those are looking pretty good for the S&P, NASDAQ 100, and NYSE. The ease of movement is declining but positive. The money flow declining but positive. Ultimate oscillator declining but positive. The copy curve declining but positive. The vortex still looking fairly solid there. The financial sector is looking really pretty good now. And rolling over, but still positive with the NASDAQ 100 momentum. And then the equity put call ratio based on 5 days is now going down. So our conclusion, we're positive, but we're still dealing with an overbought condition. We've been chopping sideways. We have to ask the question, is weakness starting to develop? And this below average volume environment just does not bode well for stocks to really go higher, it appears. We're positive in the short term, but overbought. We're focusing on that 20 period moving average study, and we did see an intraday reversal, which is not a positive thing. We're positive but overbought in the intermediate term. We're also positive and somewhat overbought in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.